Bitcoin dropped below $50,000 today in a broader crypto bloodbath, but also obviously related to what's happening in macro. Dollar getting absolutely slammed by the yen. We have turmoil in the Middle East. Basically, everything you could have on your bingo card for a bad day on a Monday. We're going to be calling this a Black Monday. I have a feeling for years to come. These are the days that I'm really glad I have three incredible experts around me to unpack what's happening. Mike McGlone, James Lavish, and Dave Weisberger. I have a feeling this is going to be an epic Macro Monday. Don't leave. Stay tuned in.
Let's go.
What is up, everybody? I'm Scott Melker, also known as the Wolf of All Streets. Before we get started, please subscribe to the channel and hit the like button. Although there's not that much to like on a day like today. Going to bring on Mike, James, and Dave right now. Gentlemen, there's a hurricane in the markets. There's also a literal hurricane at my house. So if I happen to disappear because of my internet or something, just keep talking, and we'll sort it out.
Dave's good at that. Yeah. Is anything going on, fellas?
Yeah, guys.
Yeah, so, it's probably worth starting. Donish and I on crypto on Crypto Town Hall on Friday had this conversation, and I explained that we together, ton of tag team, explained the yen carry trade. I think before Mike talks about things, people should understand what the yen carry trade is and why it matters. And then Mike can put a lot of meat on the bones. But just for those in the audience who don't know what this is, because generally people think, oh, well, it's all liquidity, it's this, it's that.
We've been talking about it for months.
Right. You and I have talked about it as well, James. I mean, look, the simple, to refresh your course is simple. Somewhere north of $20 trillion of value have been borrowed in yen to buy other stuff. And it's really easy to understand when you think about it that way. Now, what that other stuff is where it gets interesting. It started back in the days when I didn't have gray in my beard, by borrowing yen.
Mine went gray this morning. So.
Basically, for Japanese people to reach for yield, because the yield, when they've been at zero interest rates for a very, very long time, to buy higher yielding stuff. And then hedge funds figured out, well, I could do that if I have $1 billion I can borrow 10 billion or 20 billion and lever it up and buy and make n number of basis points by buying higher yielding stuff, eventually buying the US bonds and stuff, which was 3 or 4%. You lever that 10 times, all of a sudden that's 30% annual returns. That's pretty good when you're getting paid a 20% fee on your returns for taking that risk. The only problem with that trade, the real risk, is what happens, not if the currency moves, because you can hedge small moves, whatever. If there's a sharp, sudden move, and a sharp, sudden move means you lose all of that move before you can do anything. And so if you're unhedged on your yen, that's the problem. So I just want to under background. Now, the last thing I'll say before we stop is, at this point, because we asked, and we were talking to a lot of people last week, what kind of stuff did people buy with the yen and how much of it is? And what we saw this weekend was, and what we see now, is basically everything. There are probably people who borrowed yen to buy gold. Silver's down 6% today. You want to explain that one? It's the same thing. So, okay, that's my point. So now everyone knows the context. Have fun, Mike.
Yeah, the carry trade seems to be the story of the day if you're listening to the pundits in the news. But I have a feeling Mike will tell us it's a hell of a lot more than that.
That's right.
I think Dave nailed it. I mean, that's one thing. You get the macro so well, and you teach us all. I learn a lot from you, and this is just a classic unwind and it's global, it's macro, it's everywhere. And Bitcoin's the best leading indicator. So I have to admit, I watched it way too much this week, and I came in the office and I kept saying, okay, if it breaks below 60, that's your indication. Why is 60 significant in Bitcoin? Not only is it the 200-day moving average, it's also about the average price since ETFs were launched. So now all that money, all those massive, the biggest ETF launch in history, which looked very suspicious, is now underwater. on an average basis. And so I just look at it as a leading indicator. And the problem is, I love you get this lesson from the anchors when they come in and say Bitcoin's down 5% or 15%, which is actually down 20%, because they measured on a one-day basis. It trades on the weekend. It's the only thing you could sell this weekend when you saw the world's going to hell in a handbasket. At least it's just normal reversion. So that's what's happening now. At some point, that's going to stall and stabilize, but you sell what you can, not what you want. And that's clearly showing up commodities. This is a sell what you can market. Why is crude only down 1%? And you mentioned silver's down almost 6% and gold's down 2%, because hedge funds are way long silver and gold, and they're sold out of crude oil a couple months ago. So there's not a lot to sell there. And of course, we have geopolitical risks. So to me, this is just about a massive unwind. And the question is how far it goes and how long it lasts. I had to go back and revisit some of the things I started writing 2 years ago. Hand up, if I was trading, I probably would have been stopped out writing about things like reset and crude oil going to 50 after it went to 130. But now it's all tilting that way. So from our morning meeting, Ira in Jersey pointed out, we've had an inverted curve for 2 years. People forgot what matters. And now we're all tilting towards that recession. That didn't happen. Yes, there's clamoring for the Fed ease, but there you go. You saw that inverted yield curve.
It was normalized for about 10 minutes earlier, but hasn't closed there. But it was above that red for the first time in 2 years.
So let's tilt. I'll end with one thing I enjoyed reading is, I got sick of hearing all the narratives. Some people still saying buy the dip, and I say, yeah, sell the rips. This is just wait till you can see the white of the eyes. This is a 100-year event kicking in. So I listened to part of market wizards, the unknown market wizards. I used to be in the trading pits when the first one was coming out, and I remember one key person they featured. You guys probably know him, Marty Schwartz. He was a customer. I was at a firm. I had just started in the trading pits in 1988. He kept trying to buy bonds. He was early, and I remember getting yelled at him because I wasn't executing properly. I was a kid. Still am a kid, I hope. But what I want to telling the story, because what happened is he kept trading for that long bond, the drop in yield. It was around 9%. He kept buying T bonds, and it didn't. He got stopped out. Finally, he got back in, but it's what you do in leverage. I come from leverage. You get stopped out and you go in. By the end of 2089, it was about 7.8% or so. He made a killing, but you had to get hit first. To me, that's what happened in T-bonds lately. Biggest case ever seen. People bought in too early and it stopped. Now everything's starting to tilt towards, I think, what really makes sense, the inflation we got reverting to deflation. That's everything I see from commodities. And you have to hope what stops it. And at this stage, I think, sure, the Fed's going to ease, but every single time they ease, the market will bounce. I think that'll be your opportunities to be more tactical. And this is a tremendous environment for those who are more tactically oriented.
Hey, Mike, I saw Jeremy Siegel, obviously from my alma mater. I took his class at Penn, calling today for 75-bit rate cut.
Yeah,
this is the nonsensical panic that would cause exactly the chart that I've showed you guys so many, it feels like a million times at this point, which is yield curve uninverts, Fed pivots, stock market crashes. Can you imagine the lack of confidence in markets if they came out with a 0.75 emergency rate cut today?
Please save us. So Jeremy Siegel has been a permeable. I mean, he's been
the biggest
right.
bull there is.
But I remember Joseph Patapaglia in 2000 finally getting stopped out when the Nasdaq dropped 80%. That's what's happening. Maybe we'll get lucky. If you look at the Nikkei, it's just overdue. So let's start with the first bridge. The S&P 500 200-day moving average is 5,000. All right. Well, below that was resistance. Now support. Let's get there first and see what happens. And every other market I see, we're below those levels. So this is what's changed, is the whole psychology of human nature is the Fed will save us. But then you have to point out, remember, volatility in the stock markets at the lowest level in almost 2 decades. And the market cap to GDP is the highest it was on the way up since 1929. At just some point, you have to get back and look out and get out of risk assets and focus on risk off assets. So I think there'll be plenty of opportunities to buy U.S. Treasury bonds when they have those dips. And to me, that's going to be the most enduring trade for the next few years. To me, this is just getting started. But there'll be a lot of volatility in this trade.
So you're telling me my TLT buys at 84 that I've held through all of this are going to look pretty good?
Well, this is what happens in treasuries. My
hedge.
lesson is
For a trade.
most treasuries are it's the most leveraged market on the planet, which is what I learned when long-term capital management blew up in '98. Some of us actually did pretty well in that trade. I was just buying out of the money calls and Eurodows because they were going up for no reason. Like, okay, well, this means something's going on. That's kind of signals we're getting now. Is this is just a bit of an unwind. Now, hopefully, in the short term, we're always going to have those periods of calm and it's okay, it's over, you bought the dip, everything is fine. But to me, this is when you get an inverted curve, the longest inverted for 2 years on the back of the biggest money pump in history, you have to expect some reversion. Some of us was early, and we're now starting to tilt back that way.
I think it's important when we keep talking about curve and uninverted and whatever. It's really important to distinguish. We're talking about 2 to 10. 0 to 2 is still ridiculous. So and so it's important to understand what.
Yeah, but the long term indicator, the benchmark for watching for a recession is the 2 to 10 inversion. The 2 and 10 has been inverted for 2 years, and it just uninverted for the first time, which is
I'm not underestimating
right,
it.
exactly.
But generally, what you would expect a normal yield curve to look like is people pay more for risk out on the curve. People pay, the government has to attract a higher yield. Weirdly, with the carry trade being the cause, it's a very strange scenario. Now, the reason I say it's a strange scenario is because the original thought process was that people were buying that Japanese big mound of US treasuries would be at risk. And those are 10 years. And that would actually cause yields to go up if those get sold. That did not happen.
No.
Or very, very little bit happened relative to all the other assets. So it speaks volumes to what hedge funds have actually been doing and what the holders of those are. Meanwhile, the market, for those who don't understand it, are saying is basically pricing in 1.25 basis points in the next actually fairly quickly, but for over the next 2 years is what the market,
I was just on Spaces and there was a bond expert saying that bond market was telling us, and I was sort of superficially listening while prepping, that it was basically saying 9 cuts by 2025 if you're looking at bonds.
At the end of 2025, yeah.
Yeah, well, I mean, I don't know.
I think what Dave just described is 1.25 would be 5 cuts, and that's pretty soon. So, I mean, look, let's go back to. I want to go back to the Japanese unwind here, and so I just shared something with you, Scott. I don't know if can you see it? All right. So this right here is structurally what has been going on. So if you look at that blue line, that's the yen, and that white line is the difference in yield between the US 10-year and the Japanese government bond 10-year, the JGB 10-year. Yeah. You can see that just about a month and a half ago, just about a month ago, it just really widened out, right? The spread between the two, which means that the yen was a lot weaker than that spread, and the spread was coming in. So it had to revert. You can see how it tracks almost perfectly, and it had to revert. And so what we're seeing is this trade is being unwound. The funny thing is, and not really funny, and the powerful thing is, and why you saw the Nikkei down 12% last night, is it feeds on itself. Right. So as you are selling, as you are covering your JGBs, you're causing that yield to go lower, which causes that spread to go wider again, which causes the need for the yen to be stronger, which causes the need for you to go and sell more risk assets overseas, bring those, US dollars or euros or whatever over, convert them to yen, and it just feeds on itself. And this is what's been happening. And I've heard the same report, Dave, and I haven't seen the numbers laid out specifically, but I've heard the same report that this is about a $20 trillion book across all the investment firms, and that this is the problem. And so then to Mike's point is, why was Bitcoin getting hit over the weekend? What's the only thing it's trading? It's the only thing that was trading. And so if you're going to take something off your book, you're going to start there. You can start over on a Saturday afternoon, on a Sunday afternoon, you can start selling it. And so that has been going on. But that's why this has been so powerful, this move. And then the second thing is something we haven't seen in a while, which is really interesting, is look at this chart. When you look at the VIX,
For
we
some
haven't
reason,
seen a
James,
move like this.
you have to share your screen again. Sorry.
Yeah, I'm gonna share it right now. If you haven't seen a move like this in a long time.
It's insane.
I mean, this tells you that what Mike was saying is we haven't had volatility we have volatility in the market this morning. Yeah, that we are back to volatility in the market. And so the issue here is for investors is, okay, well, you can't go buy protection now. Protection's too expensive. So you have to actually take assets off the book. And this is exactly why all assets correlate to one, and which we're seeing this morning. Even gold is down this morning, right? So, I mean, it's not severe yet, and I don't expect us to get a crash, but we are going to see a sell-off here, and we're opening what in 12 minutes. So we are. What's that,
Mike?
Where are the futures, Mike?
Let me just piggyback on that a little bit. You mentioned the VIX, so let me share screen. As soon as you can grab that, Scott. I show the VIX. This is one of the key things that got me really bearish, unfortunately, in 2006. And 2007 was a bad year for me, but 2008 was wonderful. I was a trader back then. This is an indication. This line here is the VIX 52-week volatility index minus T-bill rate. It's just starting to turn up. Early days. I mean, this is the lowest since 2007. I overlay this with Bitcoin divided by S&P 500. This is going to go back to a mean, whoever knows where that is. It's just the crocodile jaws narrowing. That's how early days we are. But Scott mentioned this earlier on the program. Let's look at Bitcoin versus gold. This is one of my favorite charts for Bitcoin versus gold. It's the one I've been showing for a while. It brought me back to things I used to make a lot of money in the trading pits, and that is trading more gaps and things. And so it's reverting lower. It was showing the virgin weakness. It's trading 21. Maybe it goes back down to 15 where it was before the breakout. Not a big deal in the long term, the long term narrative of Bitcoin. But the key thing I want to show you is this is the S&P 500 E-mini. It had it on a weekly basis on a continuous chart. It started since 1997. I used to trade this a lot. We've never left a weekly gap for this long. It filled the gap from here. It still has that gap back down from the end of last year. This signals that were just so profound are kicking in. What stops it? Again, so I don't know. But in the meantime, yes, we should expect gold to sell off. There's a lot of leverage longs in there. Copper, still a lot of longs there, but gold's one more likely to recover. And that's where do we come out from here? How do you trade it? And I look at it as this, to me, is the beginning of a normal recessionary reset, and it means that at some point Bitcoin will be the outperformer, but for now it's a high volatility speculative risk asset, and that's what the market's treating it as.
Yeah, and Dave, I was trying to remember, you guys made the bet earlier in the year. I think it was maybe February or March.
We'll talk in March.
Bitcoin versus gold.
We'll talk in March. We'll talk in March.
I just want to remind that now.
No, I understand. I understand. Just like, I thought that Bitcoin would languish this summer, and I did not obviously think that we were going to have, I didn't know, but I talked about it. Look, this past weekend, someone asked me a question, so I'm glad that we have the internet never forgets. The internet never forgets. I tweeted, I got to find it again. I had it out here. Where are we? Notifications. Someone asked me about the jump trading when Bitcoin had gone down to 56, and my answer was pretty straightforward. I said, "Oh Christ."
Do you have any insight, by the way? Can you see jump trading? I mean,
no, I have no idea about it. But what I'm trying to find it because these things get.
For those who don't know, while he's looking for this, jump trading, obviously one of the biggest market makers and investors, everything in crypto, and they unstaked, I think, a huge amount. What I wrote
was someone asked me if jump trading was trading, so I wrote not a clue. But there were likely a lot of funds nervous about Monday's market action, fearing a crash. Friday felt like forced selling across all risk assets, potentially from some hedge funds blowing up due to the end carry trade. If that triggers a cascade, ... Meanwhile, crypto markets are open while equities are shut.
There you go.
And so, it's like that's the thing. And people, you don't understand the panic that's running around out there. I've made the point innumerable times that the reason why I can be relatively, I don't care, right, about my portfolio is because I don't trade it and I have no friggin' leverage. I mean, even as unlevered as this market was on relative basis, if you look, the last 24 hours was a spike to $1 billion wiped out in leverage in the crypto market. Gone, poof. And yeah, the people on the other side made money, but that $1 billion is gone. If you look over the last, since February, when I'm just looking at the chart, you're seeing there was one day in February. Bitcoin was at what was it, 63,000, and it went kaboom, and it was higher than this amount. And there were 2 days in April when we had the long, basically this amount. We're at that amount. You would expect, I wouldn't be surprised to see 1 or 2 days like this, and then it flushes, and then we go back into whatever trading range we're going to be in if global markets don't seize up. But here's the rub. We can talk about risk assets, and you talk about pricing in a world where the monetary plumbing seizes up. All bets are off. That's what happened in 2008. We saw a couple signs of that this weekend. It's worth talking about. The Korean government trying to stop people from selling.
Stop sell orders.
First sign. Can't short.
That is panic on a global scale.
Yeah, it's like the Fed cutting 100 today. Oh, that's a problem.
Right. So, and people also need to understand, it's not the price of money that's the issue here. It's the availability of money. In other words, it's liquidity. It's not the price. People keep saying, "Oh, cut rates." Cutting rates actually is like throwing water on an oil fire. Not a really good idea.
Things much worse.
Because if the U.S. cuts rates, then that triggers that loop that James was describing.
Yeah.
The yen. Now, of course, the yen has already corrected back down in the middle of its normal range. And there's no real, we were talking about watch the yen on this show many times, because we knew the Japanese government, there becomes a point where they can't afford it to depreciate more. Well, now they're perfectly happy in this range. They're not going to do anything else, right? But it's the losses. And what we never know, and what's the unknown in this market is, if you had the yen carry trade on from 2 years ago, if you could put that chart back up there that James had.
I don't think
if you look, I just want to get the dates right.
I'll pull it back up.
So if you look at it's the sharpness of the move. What is it? What does that mean? That means new money or new leverage, or increasing your leverage back at these levels. If you had it if your average cost of your yen that you borrowed was when it was at 145 to the dollar, the move to 142 is painful, not that big of a deal. If, on the other hand, your average cost, because you topped up your leverage, was at 160, well, now your body might be floating to the top of the pool, as it were, or the top of the that's what the analogy that I used on Friday was. It's a depth charge in the market. And what you don't know is how many hedge funds had reestablished their leverage at a borrowing yen at 160 or 158. And then at 142, at 20 times leverage or 15 times leverage, they're gone. I mean, they're gone.
Yeah.
What are prime brokers going to do? Prime brokers going to say, you got to sell everything, and I want to get as much back as I can.
Frankly, yeah. To that end, I just want to talk about Jump Crypto, because we have a lot of narratives happening. I think the yen carry trade, the big one for crypto specifically, a lot of people were talking about Jump Crypto, one of the biggest prop firms in the market. People might remember in June, there was a CFTC investigation announced into Jump. They had a lot to do with Terra Luna, purportedly, and they've moved 277 million worth of Ether in the past 10 days to exchanges. This is in line, obviously, with the Ethereum spot ETFs. The conjecture here, and we don't know, is, and even Arthur Hayes tweeting, where is it? My TradFi birdies are telling me somebody big got smoked and is dumping all crypto. No idea if this is true. I won't name names. The idea here is that either they're getting margin called in other markets and need to liquidate, or there's something regulatory happening. But these guys are one of the biggest players in crypto, and they're selling in line with one of the worst macro possible situations.
Well, understand how market makers are, it's like blaming the telephone when someone places a call.
They're not just market makers, though. If they're unloading their entire crypto portfolio,
but that is their most, yes.
The question is begged then, why are they unwinding their, where's their exposure that's forcing them to unwind this? That's the question.
They're not doing that on a Sunday into an illiquid crypto market by choice.
Well, I'll tell you what would cause it. There's two things that could cause it. and it's really simple. Were there hedge funds who owned a ton of crypto and had used borrowed yen to do it, and if they did that, then their losses on the yen were sufficient. They had to sell what they had bought with it, and boom. Are there Japanese-based funds? Are there Japanese-based banks, smaller banks, bigger banks, whatever, funds that are sitting out there, or funds that had significant Japanese investments that did that? And if the answer is yes, then that's exactly what happened.
Yeah.
Now understand,
that's it right there.
Of course, that's why I made the point. We don't know what the stuff they bought. Now understand something. The yen carry trade, when we say it's $20 trillion, we say that blithely. The entire Bitcoin market is $1 trillion now at this price? Less? I don't know. But it's not. It's a 20th of the size of that market. Bitcoin is tiny. I mean, there's a lot of stuff. There's a lot of pain out there. When this sort of thing goes bad. I mean, the yen, the Nikkei being down 12%. What I don't know, because I'm not current on the market structure rules. That sounds a lot like some circuit breakers being hit, and we don't know what'll happen tomorrow.
So
yeah, well, Mike, I mean, markets go live in 2 minutes, right? So
I just got to follow up on a little bit. To me, the yen carry trade is a significant leave in the forest of what's happening here. It's the major source for funding, but it's also indicative of very liquid markets, massive liquidity, and extremely low volatility. So when you borrow that money, you're a hedge fund, you're levering 20-to-1 which was all my futures customers. You find in places you can get in to make money, low volatility, and you hit your stops and you just put in stops. That's what I point out that volatility chart. It's just getting started. So that's one of
although the VIX hitting the high 60s it hasn't hit that since the start of the pandemic.
That's my point, but it's that moving average. Just one day, okay, sure, that makes the Fed ease. Everybody says, "Oh, the Fed's going to ease," and you bounce.
We should talk through that. Finish your thought, Mike, and I want to talk through the Fed because this is what people are talking about now.
Here's what's going to happen, and I'll make a risk of saying this. We just went through the biggest period in history of what Jeff Booth warns us about is humans are about error correction. We created way too much liquidity, and the biggest pain from it was the biggest inflation of most of our lives. And we learned that lesson. So when the Fed starts easing, without the severe deflationary forces, there'll be pushback. But they will ease on the back of the severe deflation forces. But remember, the plateau is so high now look at all these massive cryptos, that just the average price of a home. For everything just to mean revert maybe 25%. That to me is what's happening. It's just getting started, and the cycles are. So here's one thing I'll end with this. I've been wanting to pen a piece for a while throughout the models and break out the history textbooks, which is what I've been doing, the history books. And all the cycles here are just kicking in. It's going to be nuances in between. And this is just one, okay, it's a couple days now, but Bitcoin's the best leading indicator. But also I used to say Bitcoin and 30,000 wannabes. Now there's maybe 1 million wannabes. That's just too much speculative froth in assets people buy because they go up. They have to stop going up to take out that froth. And there we go. This is what we're doing now.
Yeah, and I think that I agree, and I think that the Fed actually is welcoming this. They're welcoming a sell-off in the stock market. It helps them. It helps them on the inflation side because our economy is so financialized, and it's so tied to the stock market that having the market sell off actually helps them. For the first time, they're getting help rather than fighting the headwinds of fiscal dominance coming out of Washington. Now they've got a little bit of help here. They're not going to come out and say, we're going to cut rates intra meeting here yet. They could deal with a nice, 15, 20, maybe even 25% kind of ease. What they would do is they would step in when the credit markets start to look shaky. And that's we don't see that yet. But if we see the credit markets start shaking and we have a problem with those assets, and we've got a 3-year, a 10-year, and a 30-year auction this week, I expect there's going to be a flight to safety in that 2 and 10. That's my expectation. If that doesn't happen, if there's a greater problem and you're seeing asset managers having to step back and not take on the 2s and 10s because of this massive unwind of the carry trade, then that's going to be an issue. And that's when the Fed and the Treasury will step in and say, hold on a second. Okay, enough's enough. Well, maybe we should, we're going to back off QT altogether, and maybe we'll have a new acronym or whatever. And maybe we'll pump the brakes on intra-meeting here and have like a 25 basis point cut just to calm the markets. But that doesn't help really to spur demand for the 2s and 10s anyway. So it's that's what you got to be looking for, is the credit markets.
So the market just opened. So obviously it's worth discussing. I've got SPX here. Obviously, I think closed 5,300-ish, open 5,150 down. Yeah. But look at the Dow. I mean, the Dow closed at 39,729, opened at 39.
Yeah. The S&P is down 4. It looks like the NASDAQ is down 6%. Like this is truly significant. Now we're in significant territory.
So let's point out what Dave very early on. The T-bond yield right now is 4.01. Effective Fed funds upper bound is 5.5%. So there's a lot of room to ease. But the thing has been restricted forever, and I agree completely with what you said, James. But this is what's different is it's the delayed reaction of getting too expensive. It just, the Fed knows we're 2 times GDP in terms of market cap and stock market. And if you want good deflationary forces, just look on your screen at S&P 500. That's your number one. That's a 10 on deflation or inflation. And it's all heading that way. And what stops it? I don't know. To me, this is just early days. So to me, from a tactical oriented, what do we do now? I think you're supposed to sell rallies and risk assets and buy dips and risk off assets like gold and treasury bonds and wait for those opportunities, and there'll be plenty of them.
Now, I would say a couple things. First, I want to go back. I want to put a pin in what you just said, because I would put an asterisk on it. But yes, that's fine, and I'll explain myself.
We'll pin the asterisk for you, Dave.
Pin the asterisk. But what James said about the financial plumbing about the Treasury is true. But there is one thing that people need to understand, and it is not necessarily the cost of money, i.e. rates. It's the availability of liquidity. What we do not know and will not know is, are there banks that are prime brokers, i.e. because they're all banks, that are in severe distress?
Exposed.
And if the answer is no, then this is going to be a buy the dip.
There's only one way to find out.
If the answer is yes, then we might finally get that delinking that we've been talking about after a serious amount of pain, because the answer being yes is not obvious. We don't know. I mean, U.S. regulators, U.S. banking regulators have a pretty good idea. And if you think that there haven't been emergency calls over the weekend to every one of the money center banks, from the OCC and the Fed and the Treasury, then you're literally smoking something, and it's not a high quality thing that you're smoking. Those meetings, those calls happen every time you get a weekend like this. It's like, how are you? What's your balance sheet look like? Are there any issues? We need to know. Don't you dare lie to us. I don't care what your VAR model says. With this, et cetera, et cetera. Talk to me. And so those conversations.
Goldman CEOs on the phone with the New York Fed right now.
100%. So, but this is not that. The likelihood is there are Japanese banks or Asian banks or European banks that got in and provided too much leverage to some funds that are floating to the top. Is it enough to trigger issues in the banking system, which people have to understand? One of the reasons that I'm so bullish on blockchain, I'm very bullish on Bitcoin. We understand why. I talk about it a lot, and I'm going to get back
bullish on you, Dave.
The bullish on blockchain is one of the obvious use cases that will happen, and it will be triggered by the next big financial crisis, which, by the way, I don't believe this to be that, but that is what it is. It could happen, is the fact that Lehman went under in 2008, and this estate is still not unwound. Just think about that for a second. 16 years. The reason is derivatives are bi-party or tri-party, and that's it. And there's no mechanism in the world to step into that and clean it up without armies of lawyers and forensic accountants dealing with it. So what is the point of this rant? Point of this rant is, if there is a body floating to the top of significant size, it may have thousands of trades with other counterparties, such that those counterparties have no idea what their real
risk. They don't even know their counterparties.
And that, if you want to understand what happened in 2008, because I have friends that are in emerging market debt, and they were telling me they've never seen anything like it. There were 2 or 3 months where they couldn't do a trade, like nothing. They didn't know. You asked them the question, "Are you bankrupt?" I don't know. was the most common answer. Now we're nowhere near that point.
I think that this is probably closer to a multi-fund situation a la long-term capital management. I think it's closer to a 1998 style, fear here. That's what I'm not worried about there being a structural issue across all financial markets like we did with the mortgage market. This is a little bit different to me. It might be like, I think Mike was saying, you're going to see one of these funds you're going to hear somebody blew up. And when you hear that, then you're going to say, okay, where's the contagion and how big is it spread? And does it spread to the big banks, just like you guys are saying?
And so what does one do in that scenario? If one hasn't levered, one backs up the frickin' truck.
Right.
And I just want to be really
not financial advice.
I'm not giving financial advice. I'm telling you, buying Bitcoin under 50,000 10 minutes ago, you're up $2,000.
There you go. It's a significant trading vehicle on the planet.
You play around now, but Bitcoin is different than altcoins. Understand, when you get $1 billion in liquidations in the crypto market, almost all of it, and by the way, it's fascinating how much of it, I wish I knew the answer to this, is Bitcoin, Ether, and Solana. So it's clearly cap weighted. Usually when you have these big liquidations, it's not necessarily as cap weighted as this, but this one is ridiculously cap weighted. It's 347 million liquidated in Bitcoin, 315 million in Ether, which, by the way, that is crazy. More Ether liquidated than Bitcoin, relative to its cap by a lot. Solana more or less on point at 48. Then you're all the way down. XRP is 10, Doge is 13. And then you start getting into the single digits throughout the rest of the cap structure. So basically, this was despite what your portfolio of crap. So with all due respect to Mario and Rand, who we'll talk to in Crypto Town Hall.
I also have a portfolio of crap.
The portfolio of crap may very well be doing worse, but the fact is it wasn't leveraged worse. The leverage was all on the large caps, and that tells you that it was forced selling. That's how you know.
Okay, Mike, I have a question specifically for you, and I'd like you to unpack everything you've been hearing. This is kind of a Mike day, in my opinion, but we have the dollar obviously absolutely dumping DXY, right? We know that this is a function of what's happening with the yen, but I think amateur traders expect that when you see the dollar or DXY, which is the dollar versus a basket of currencies, to be clear,
it's a basket of, it's not that many currencies. It's not across the whole world. So
Euro,
the
Japan,
yen is a big portion,
heavily weighted. Yeah. Correct. But people expect, your amateur trader goes, I need the DXY to dump so that my risk baskets can go up. Right? That's what people think. We listen. We all
go get him, Mike, because I know we're going to agree.
Right. So
the lesson we learned when S&P downgraded the U.S. debt is never be short U.S. dollar when there's the major calamities kicking on. Now, obviously, it's weaker today, and certainly if there's missiles flying globally, I mean, seriously, that's what I point out when people are bearish down. I'm like, where are you going to go? Right, go buy those yuan bonds. They're really going to do well for you. So what I look right now is you look at the dollar index. It's still up 1% on the year. The trade weighted broad dollar index is up about 4% on the year. So that includes the renminbi and the yuan. So yes, we're having a pullback here, but we did see a rate hike in Japan, and markets are cutting rates in the rest of the world, most notably the U.S., and some of the rest of the world are cutting. So I look at it as I always tilt over the crypto. When some of my strategists were getting bearish the dollar a few years ago, and I pointed out, are you ignoring what's going on in cryptos? I mean, the base layer is the dollar. Most widely traded crypto is Tether. That's a pretty significant statement that the dollar is still the profound global currency, and more so. So right now I see it as this is more knee-jerk reaction. It's markets pricing in this significant amount of easing, which means lower yields in the U.S. That's been the higher yields in the U.S. has been a key support factor for the dollar. But I'll end with this. The key thing that's been consistent with a strong dollar versus a basket of fiat currencies for at least a decade has been the U.S. stock market outperforming the world. So I don't know exactly what the dollar is going to do, but I do point out this is the lose-lose, and I have to admit I started pointing out too early. That's just starting to kick in. U.S. stock market goes down, the dollar initially goes down, but it brings everything lower, and that's why I always tilt over to betas, and number one thing that matters here.
So is this a situation then, really quickly, dollar goes down in the short term because it's very yen specific, right? And as James said,
Yeah.
I mean, maybe the yen
DXY.
stabilizes here,
Yeah.
right?
If
So
you,
then
if
if
you look at the dollar,
DXY is going to go
yeah,
back up, it's going to wreck everything.
yeah. If you looked at the dollar against everything, it'd be different calculation than you're seeing in the
Right.
DXY. That's
Yeah.
the point. But
That's what the trade weighted broader dollar does. You can't trade it, but you can look at it. It's on a trade weighted basis. Fed's been publishing it for 50, I think 60 years. I watch it closely. It's got the highest negative correlation to commodities. But again, the DXY is what, 2/3 the euro.
yeah.
Trade weighted broad dollar is 20% the yuan. At least it used to be. That's trades declining.
Yeah. I mean,
Dave, go ahead, James.
Look, everybody's this is one of those mornings where you're trying to find your mooring, like what are you balancing here? And I'm just going to keep coming back to is just watch the credit markets. If you want to know if there's something really structurally wrong, watch the credit markets. And so we are going to see a flight to safety here. I agree with Mike. Yeah, but they're not going to be buying duration. You're going to see a flight to duration. You're going to see a flight to safety in the U.S. Treasuries for anywhere from T-bills all the way up to the 10-year likely, which is the benchmark Treasury of the world. And so that's kind of what we're watching for here. And if you start seeing dysfunction there, then something bigger is happening, and so that's kind of your clue. But like Dave said, look. If you have powder on the sidelines, I have powder on the sidelines. I'm using some here. That's me, that's me. I'm using some here, and that's okay. I'm not going all in. I'm not backing up the truck yet, but that's me. It's everybody. Just like Scott joked about it, and that this is not investment advice, but it's truly everybody's in a different situation, very specific. So be careful. I would be very careful with leverage, because if we do see some sort of structural issue with credit, then your leverage is going to get blown up. You're going to blow up your portfolio and right in your face. So I would just be extraordinarily careful. And I personally don't use it. So
Dave, before you jump in, because I know you want to, I just want to say to that point, these are the situations where everybody loses. If you believe in the market inflicting max pain, I literally tweeted about it. It says, what would be the worst thing? You have this huge dip, then a huge bounce this week. Everybody gets long, they get liquidated. Longs and shorts all get liquidated. Everybody loses back down, right? I mean, there's just the volatility here. I mean, Dave made the point. Listen, if you bought Bitcoin under 50, you're up 2,000, but in 10 minutes, you might be down. If you got
down
long
to 51s. Now you're down to 1,000. But the traders that are watching this and jumping in and out are making a fortune today. That's always the days that happen. I mean, I'm not going to complain, considering what my company does for a living. We provide software for those traders to do a better job trading. And so, that's what we do. But, it is what it is. The simple reality is that people in crypto feel like we're in a bubble and we're looking, look at what Bitcoin's doing. It's like, but it's in the context of a broader market. And it is absolutely true that the Fed, that inflationary pressures are being stoked by the wealth effect. There's also a political year and what's going on. I don't think this S&P move matters at all to them. The NASDAQ move, maybe so, maybe not much. The issue is, is there stress underlying it? And that's what James nailed. He's absolutely right. If there's no stresses, then the reality is they don't have to do anything. People like Jeremy Siegel could tweet whatever he wants. I mean, that's the old, is the Fed put alive? All three of us have agreed on this, and we've all been saying it for, a long time now, that the Fed doesn't care about the stock market. The Fed cares about the credit market. What has happened? Well, if you're sitting there in Powell's shoes and you look at your long bond and that, hey, guys, our yield is actually 3.7, and it's actually doing okay. It's going down. That's what they want. I lost track of how many times on this program I've said the Fed wants our yields to be lower so the government debt doesn't go up by as much. So when James his little thing, yeah, absolutely, they want that.
All in a day.
They're not going to do anything to change that. Why would they, unless there was political pressure? Now, I'm not saying there won't be political pressure, but that's the issue.
If the market does crash, which, we're having a solid sell-off here. If the market does crash for 2, 3, 4, 5 days in a row, there will be tremendous political pressure for the Fed to lower rates for optics. But just like you guys said, that's not going to help really the stock market. It's, that's just.
Nasdaq's recovered 2% of its fall. It's down 4%, not 6%.
Yeah.
That's
Dave, I also highly recommend people, if you didn't hear my conversation with Lynn Alden 8 days ago, she made the very clear point, and we talked about the fact that everybody watches monetary policy and the Fed, but we might be in a fiscally dominated situation where the Fed really is kneecapped because of what the Treasury is doing. Right. So like James just said, it would be a kind of a Band-Aid in a situation where fiscal dominance might be rising.
So I enjoyed that interview you had with Lynn. I think she pointed out, it might have been Jim Bianco pointed out, that government spending is about 20% of GDP now, which is about the highest since the war. But I want to go back to what you said earlier, Scott. A lesson I learned from a former hedge fund manager I worked for is bear markets will take money from everybody. But the difference now, what I think is shifting, and I agree with what James says, there's going to be tremendous opportunities to buy dips. But this is what things that really shifted in commodities. In about this year, it shifted from a market of a commodity market to a market of commodities. And this is what I think we're way overdue for. This is tremendous for the technically oriented, but buy and hold, good luck. I mean, it's just maybe in Treasury long bonds until they get to where they are in the US and in China. It's just the way it works. So we should get decent bounces. There should be feel good periods when, and the say, who knows where the level is. Maybe S&P 500 drops to 5,000, then rallies and everybody feels good. But to me, that's the opportunity. Buy those dips, but be tactically oriented. Remember, keep stops and think more tactical now. And there's tremendous opportunities. And then at some point when we get those rallies, be very careful when volatility drops. Everybody's complacent, because to me, this is the turn that's way overdue. A lot of us have seen this before. Just to get some normalization and risk asset valuations. They're so expensive still.
Right, but what's normal here, Mike? So we've got
we won't determine that. What's normal is shifting back to 1-to-1 market cap to GDP. Gold maybe going back to 1-to-1 S&P 500. No stuff that used to matter. The curve going back to at least 100 basis points premium in 10 and 30-year bonds versus short rates, just a matter of time. And that stuff will come back. It's just a matter of time. And now I think we're in the transition now.
Anyone want to continue there? Go ahead, James.
Yeah, no, I mean, that's the difficult part of these kinds of markets. The difficult thing is that you just don't feel like you understand what's going on. If you understand that, like everything we've laid out here, if you understand that, you can just keep your head and not panic over everything. Your portfolio likely looks like dog do today, but it's okay. I mean, like these are periods that occur. It's a time not to get, shaken out and panicked or over levered, but there are opportunities that can be provided. You can shift some assets into less risky assets like gold and all that. I can't do that in my portfolio. I'm a Bitcoin hedge fund, but there will be opportunities to take advantage of. I mean, I'm seeing tons of them, and that's good for me. I mean, but I have a long-term view.
These are the periods when, I mean, look, this is when opportunity is made from. Right. When correlation goes to 1 because of exactly, and Mike, your exact words are great. You sell what you can sell, not what you want to sell. What does that mean? That means the market is mispricing stuff. What is the number one thing the market is mispricing today? Bitcoin. Why? Because the option value of Bitcoin and its chance of getting long-term acceptance is probably 10x what it was 6 months ago. And we are at the same prices that it was 6 months ago, in the same range with the same volatility around the same stuff. And that matters. Now, does it matter for a day or a week or a month even? No, but it could. But but the simple fact is 6 months ago, you had one fringe candidate talking about it. Now we have a roundtable today with the Democrats, and you have the Republicans basically saying
it's been delayed. Yeah, it's been delayed.
Well, obviously there's crap going on, but you have all sorts of reason to believe that global acceptance of Bitcoin as an asset, as opposed to as a toy, is increasing. and it has not been reflected in the price. That is that delinking, and that can only happen from the ashes of pain. And because that's where it was born from, that's where it's there. So when the only thing that Mike has said today that I disagree with, and it's been what I disagree with the whole time, is that gold Bitcoin ratio when you're looking when one is an asset and one is an option. And so I don't think that the world works as it will gap in the other direction. I think that there'll be a series of gaps. But I think the time period that you look at that ratio matters, because the ratio itself is only relevant in this period of time since we had a massively over-levered, ahead of ourselves price in Bitcoin.
So
I just want to show Mike could go. I just want to tell people on Down Detector this morning, this on Bloomberg, users are reporting issues with many of the most popular online trading platforms. I'm seeing it in my group chats everywhere. Nobody can trade anything right now. Schwab's down, E-Trade down, Robinhood down, Fidelity not working. I mean, it's mayhem out there.
Everybody goes to the same exit at once. I really appreciate when Dave praises the Bitcoin Lord, and I say pass the ammunition. And I still think
you're right. As a trader, you have to.
Right now. So exactly. So I'm looking on my radar for. I hope what you said is going to be right, but I'm on my radar to looking for the pattern recognition and the signs that it will start showing that. And I still point out that it's showing me the opposite. It depends on how you look at it. So at some point, you're probably going to be right. But right now, I look at it as if there's any kind of dip people should be looking to buy, it's good old U.S. Treasury long bonds and gold. And Bitcoin at some point, but when you feel good about buying something that's 3 times the volatility beta, then go for that. But right now, it's still, that's the problem. It's just the highest vol. It's the fastest horse in the race, and the whole race is going down.
Yeah, but the thing that's interesting, and people, and I've said this before, and James is about to nod. It's not. The beta, when you look at the beta of high beta stocks, yes, it's unstable, and yes, because look, I manage portfolios where we've actually studied this stuff, whatever. The difference is most of that volatility is you can pretty well know, it's a pretty good relationship. You give a 50 basis point or 1% move in the underlying and something is beta 2, it's moving 1% or 2%. That is not what Bitcoin is. What Bitcoin is gap volatility, like massive gap volatility. What is it? 20 days holding Bitcoin for 20 days is all of the rally, and it's been negatively correlated to the stock market for the last 6 months overall. So beta, when you're negatively correlated, basically means it's bullshit. It's just there. It's sort of like a famous statistical thing. We always worry about overfitting in quantitative finance, and there've been a lot of famous ones. I mean, the yak production to the S&P was a famous one of overfitting. It was yak milk production in Tibet was correlated to the S&P for a couple of years. And it's like, you can find stuff like this. I just think that your theory on what Bitcoin is overfitting and using too much in the way of smooth moving averages to be incredibly meaningful. Now, that said, everything you've been saying about the great reset and what's in there and pumped up is there. The only real issue is, will this be that great unwind? I got to tell you, I think when the great unwind happens, Treasury bonds is not where you want to be, because people will have lost
long term. Yeah,
not long term. That's my point.
So there's some hopefully it'll be
but it clearly is going on today. So whenever someone
on duration and a great reset,
I just want to make one last point. Okay. When someone asks me, is this the stock market crash of 87 style crash? My answer is going to be only if the bonds and stocks are going down together, and they're not.
So in 1987, Martin Zweig made a killing long U.S. Treasury long bonds. They went limit up 3 days in a row. I stick with that same outlook, and I want to see signs of that not happening, because here's the problem. One of the things I do is I sit at the desk and I talk, what's the most highly valued, I think, position that's underweighted and that doesn't, and that's probably poo-pooed on and pushed back upon, and I think for the next what period? I'm thinking a couple of years. So that's why I've been pointing out TLT, and that's what I tilt back over to. This is a most hyped up market I've ever seen. That's Bitcoin, particularly when they launch those ETFs. Like I said, go back and read or listen to Market Wizards or Lead It, the latest one. It's just a classic science that I learned in the trading pits. When I look at all my screens, CNBC, Bloomberg, CNN, when they all kind of point out the same thing, how good stocks are doing. Typical trader environment. No. Right. I'm doing the signal from the pit.
But most hype market you've ever seen? Were you not on a trading desk in 1998 from the time that long-term capital was resolved?
Slap a .com on it, and you get $1 billion valuation.
No,
So,
it's not even
so the
close.
same
Bitcoin's been
signals.
flat we've been in a trading range. It's been flat for 6 months now, or since
The
Now
March.
we're
same
not in a
signal.
range.
Well, not
But
anymore.
let's
Not
clarify
anymore,
something.
because of the signals I saw in 1998. So in 1998, if you want to go back there, I was long way out of the money Eurodollar calls with clients, and we had leveraged the first series expired worthless, and then we bought some more. Why? Because the Fed had not started easing, but all these markets are tilting higher. I'm like, something's going on here. So we just started buying these out of money calls. When long-term capital hit, management, what we had lost a few times went up 10x. The same signals I've been seeing lately, and it's just starting to kick in now. Maybe it's wrong, but
But what happened right after that? What happened
well,
right after that was one of the
it-
most ridiculous
it
bull
was-
runs in
it
risk
was.
assets you've ever seen.
How long did it take? It's not a day. It's just getting. This is like
Oh,
1 week.
absolutely. Oh, and now we get to so all your viewers who love to watch Mike and I spar, now I disappoint them. Exactly right. I'm not calling for a day. If I was calling for a day, I would say but I would say lever up. If you ever hear the words lever up out of my mouth on this show, it's proof that some pod person has taken me and I've been replaced by somebody else, because I'm not saying that. I agree with you, but the point is anybody who bought risk assets, particularly at the time tech stocks, at any of them from 98 through 99, when Y2K, everyone was afraid the world was going to end because planes are going to fall out of the sky. You did ridiculously well, and then of course if you didn't sell them, you ended up getting crushed. So a year and a half later. But the fact is that run up was epic, and all I'm saying is that certainly Bitcoin. I'm not talking about altcoins, but certainly in the case of Bitcoin, because its narrative, it could easily delink from all this crap. I don't know that risk assets have a whole lot on the upside. I agree with you. I think that most having a GDP ratio of market cap to GDP where it is means there's not a whole lot of room on the upside, because because that market cap is literally of companies that are producing the GDP. So you need to have something that's outside of that system. And that's all I'm saying. That's where our difference is. And past beta is it in the system. That's all.
I wish this could be a 3-hour show on a day like this. And I wish it could be Macro Monday every day. I would like to just invite you guys back. It would take all the stress off me of planning shows. But I do want to say something. So it's funny watching the chat and the Twitter comments. Mike, people have been criticizing you for what now, a year and a half on this show, something like that. It took all of 1 day of price action for the consensus to be Mike was right. That's how fast sentiment changes. It's just a really good gauge of how fast things can change. And I want to say, we all make predictions. We're right and wrong about a lot of things. I said March, I think we've topped. Right. Okay. I also said trading in but I also said, trading in a range, totally fine. Can't say we're trading in a range. Now we went back to the price of when the ETFs were approved today, guys.
No, the ETF approval, the spike on that day was to 49.
Okay. I'm saying, and we hit 702 today on Bitstamp, and below that on Binance.
I hate to tell you, I hate to say this, but I'd have to go back and look at August of 17 and the price action in August of 17.
Yeah, I mean, Peter Brandt literally tweeted that now we have the normal correction. Here it is. I found it. Please note that Bitcoin decline since halving is now similar to that of the 15-17.
Exactly right. Yeah, I'm glad. If
I bring that back.
With all due respect, Mike, when I'm on the when you and I are on the other side, I think that we agree actually, and we joke it with each other.
We do.
I do not want to be on the other side.
I'll mention one thing. I posted this recently. I had to put it on X. I had to take 2017. You take the 200-day moving average of Bitcoin, overlay with the 200-day movers in S&P 500. It's the same chart. Bitcoin just moves more. Why? Because that's when futures got started. I was asked to comment twice, 2 Sunday nights in a row by Bloomberg Radio on Sunday night about these futures launches. I remember that's your key sign. When they asked me to comment on these things, there's a peak. But this, the point is, I want to see those 200-day moving averages, maybe 20-day moving averages, just diverge. Right now, they're all starting to roll over. That's just, and the 2017 was significant.
For trading capital, I agree with you. I have money that I want to tuck away for a long-term investment. I don't want to miss those the next 5 of the 20 days that are all of it. That's the difference for people. It's a very big difference. But what mattered is, look, the introduction of the futures in retrospect, is one of the most obvious, ridiculous signs. Why? Because it was the first time that people in the US could actually take the other side of that market. There was no way to short it in the US, literally none. And so that was a big deal. We don't have anything like that. There's no capital mismatch here. This is, oh crap, I got to sell shit because I'm getting called by my margin collector and I don't want to go bankrupt. And Bitcoin is one of the things I own. And we always have to come back to that. And so if you believe the world is that we're going into a serious, massive reset, everything is going to fall. If you believe that they will stabilize the markets and that the yen is already back and the pain is there and we'll see what happens and it's going to shake out, then this is a really great opportunity to buy things that you believe to be undervalued in the long term. This is not a good time to be speculating on whatever armadillo JPEGs. I don't believe, but I could be wrong.
I don't know, man. So I did tweet last year, I know we got to be done, that jokingly when Bored Apes were at 300 grand floor, I went on a Spaces and I said, I'll buy one at 25 grand. And they all told me I was nuts. I haven't had time, but I think they hit $18,000 today.
Wow.
But typically the time to buy Bitcoin is, if I can show that screen real quick, I'll finish up, is when that 200-day mover average gets lower, tilts lower, everything's low and everybody's bearish. And right now everything's still pointing upwards. This is like day one, and you're going to get bounces. Exactly. Traders love this, but that's my point. Just look at that. I'm like, all right, when that diverges, I see significant signs of it early on, I'm with you. But right now it's still showing that this is the problem.
Forget leverage, dude. Had you bought Bitcoin when James and I were trying to calm people down, at the beginning of this show, you're up $3,000 now. I mean,
exactly. But that's the key thing. It's the most significant.
Where will that? What is just? I just to put my line in the sand because I like making fun of myself. We fell from 62. Wherever. Where were we at? 62, 63 when I was trying to write my newsletter down to 49.
Oh, I wrote my newsletter last night, dude. I had to literally.
I had to throw mine away too, and I'm about to jump in a car for 7 hours, so I'm going to be up late tonight writing my weekly newsletter. But okay, screw that for a second. But just do the math. We have $14,000. I would say that I would be stunned.
There you go.
Stunned if we don't hit 56, because that will be retrace at least half of that down move. I'd be stunned if we don't hit it. Will we hold it? I don't know. But will we get back up toward where we're
always get the 50% bounce?
I would be surprised. Oh, by the way, it's 53.7 now, so now we're almost $4,000. And by the time we get on Crypto Town Hall, I think I would literally be surprised if that doesn't happen.
Yeah.
Well, that's wonderful for the trader. This is an ideal environment for the tactically oriented traders. For the buy and hold people are way overdue for a little bit of wealth destruction, and I think it's just getting started. But trading people have a great time.
Dave, I literally just pulled Fibonacci levels.
Who are buying and holding is you want to hold something that has actual fundamental value tailwinds and not something that is at the most stretched debt GDP to market cap to GDP in history. And that's my point. So what's the trade that I said people should be thinking about with the appropriate betas is long Bitcoin, short the overstretched market.
Yeah, Dave, real quick.
I said it many times.
Right now, you got a 50. You just had a 50% retrace of today's candle.
Okay, well, so that was
58 to 49 and bounced back to about 53.7. Right there. There you go.
Okay, fine, cool. There you go.
Yeah, Nasdaq is now only down 3, and the S&P is only down 2.5. So
there you go. And
Mike, you got to be just shaking your head, man. It's the first.
Oh no, this is great. So when I was and all the time I spent with clients and trading, this is an ideal environment for trading. But that's my point. That's not a trading. This is not a buy and hold environment anymore. It's now for traders. It's now a market of stocks rather than a stock market that just goes up. It was a market of commodities that's going up. The commodities led the way here. It's tremendous for trading. So trade all you can. Trade with stops. Always have your stops. I'm owning no leverage. It's my background. But the macro is, you see what I showed here. The turn is happening.
Yeah. Okay. Well, Dave's got to drive. James has to trade, and Mike, I'm assuming, has to dance. If you don't, I'd be very disappointed. I literally wish we could do this for hours. Now we got to go to Spaces. By the way, Spaces is on Mario's account instead of Crypto Town Hall. I was hosting it before this because they didn't want to. The finance Spaces is just rolling into the Crypto Town Hall Spaces, which makes a lot of sense. Also, yes, I'm aware I said fidelity in my interview with Yuri and Timmer instead of fidelity. Everyone's upset that I still can't pronounce fidelity.
Oh, how dare you!
I know,
but
I see it in the
but when
comments.
you're on the street, you just call him Fido. So
That's right.
Exactly.
Fido, it's fine, man. So, but that podcast yesterday was pretty epic as well. So you guys check that out, guys. I know this is one of those days. Everybody's got stuff to do. Thank you so much.
I can't believe I'm going to be in a frigging car for the next 7 hours. That's all.
I'm gonna go check on my traders.
Yeah. All right, guys.
They had all their orders pre-market. Let's see what happened.
Yeah, we're gonna come back in 20 minutes and see if everyone was liquidated or celebrating. That's all we got for today. Thank you. Bitcoin 53,500. What a day. Thanks, guys.
Take care.
Bye.
Bye.